Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenevec on Bloomberg Radio.
All right, everybody, we begin this hour, though, with the most read story on the Bloomberg in the past 60 minutes. President Trump said he would refrain from imposing tariffs on goods from European nations opposing his effort to take possession of Greenland, citing a framework for a future deal. I put quotations because those are his words. He was reached regarding the island. So we're talking about the island, of course, of Greenland. So it was kind of like a wait, what moment for a bunch of us, because the president has been for days leading up to Davos talking about acquiring that island. So maybe he found an off-ramp. So let's see what Nick Wadhams has to say. Bloomberg News national security team leader Nick Wadhams is in the Bloomberg DC News Bureau. It was, Nick, it felt like a little bit like a wait what moment, although we did have some market observers yesterday saying that, you know, the president's going to figure out a way out of this. How do you read? What's your read on this?
Right. I mean, it's one of those things that's a little bit shocking, but not entirely surprising. We've definitely been through this before, where the Trump administration, the president himself, ratchets up pressure, says he's going to impose tariffs, and then backs down right at the last minute. The big question is going to be what this framework agreement will be, what it will entail, what will happen to Greenland, because the president was quite explicit in his comments today that he wants Greenland as U.S. territory. So what the back down is going to be there, but also then, of course, what happens in the future, because we've been in this cycle so many times where he escalates tensions, backs down, and then escalates tensions again. And it's a sort of rinse and repeat situation. So markets are certainly happy, but I don't think there's any indication, at least that I'm seeing, that we're anywhere near out of the woods, and you won't see the president just ratchet pressure up once again as a negotiating tool if this framework deal, once the details become more specific, aren't really to his liking.
Well, he did make a comment earlier today in his speech at Davos, Nick, that he wouldn't use force. And I'm wondering if which is great, as you know, we don't want, I just want to say, like, we don't want conflict here. I think I can say that. But is there another way to do this if somebody who is not selling something says they're not interested in selling that thing to you? Like, I don't understand the how to thread that needle.
Right. I mean, to me, the most likely scenario is that you would see the U.S. put more military assets in Greenland. Of course, that's something that the U.S. has been allowed to do for many decades. In fact, over the decades, the U.S. has drastically scaled back its military presence in Greenland. And Greenland and Denmark have absolutely no objection to the U.S. bolstering military assets at bases all up and down the island and putting essentially as much as they want there. What you heard from the president today as well was this mention of Golden Dome, which is his so far unproven, essentially, missile interceptor system that he wants to put in place at a cost of many, many billions of dollars. So it's possible that what happened here is that Greenland, NATO, and Denmark all sort of said, okay, we're going to be willing for you to station Golden Dome there. And that was enough to mollify him. But, you know, as usual with these things, it's not clear how much the president knows about the history of U.S. basing on Greenland, what he's allowed to do and what he's not allowed to do. So it's entirely possible, for example, that they presented to him this thing that might be seen as a big concession, but was something he could already do in the first place. So needless to say, we're trying to sort all that out right now.
Yeah, my brain hurts a little bit, Nick, because I do feel like...
I'm sorry.
Are you laughing at me? No. He's laughing at me, Nick. No, but it just feels like...
I'm just sad that your brain hurts.
What did we get? What did we achieve as a nation? And I just think about some serious situations that are still going on around the world. Some Americans would say, we're still dealing with a war between Russia and Ukraine an ally, right? Or, you know, we still have stuff going on in the Middle East. We still have stuff going on in Minneapolis, Minnesota, our home front. I'm just trying to understand the amount of time and, spent on something like this, and I'm not quite sure we got as a nation out of that, and as an American, what we got out of that.
Right. I mean, well, I think on the one hand, you have the president's view, which is he sees this pressure, dialing up, ratcheting up the pressure as a legitimate and successful strategy. I mean, you look at NATO itself, and he has one of the foreign policy achievements he has had, according to the administration at least, is this idea of getting other NATO countries to commit to spending 5% of GDP on defense. And that's not something they would have done, certainly not at this pace, unless he had done that. So, you know, he may see this as something where the U.S. gets an increased presence on Greenland, has the ability to install Golden Dome, bolster its military presence, and portray this essentially as a win. Under the knowledge that a lot of people, certainly his base, are not going to look back and say, well, hey, you guys could have done that anyway, and you could have done it without all of this chaos and drama and brinksmanship with an ally. But, you can be sure that he is going to portray this as a win, and the result may likely be that the U.S. will have an increased military presence in Greenland, which is something that folks on both sides of the aisle, there are certainly voices who would advocate that that's an important thing to do. Yeah,
and maybe all the cards are being laid out on the table. It may feel kind of messy, but there's certainly a lot that's out there at this point, Tim.
Hey, Nick, before we let you go, Article 5, the collective defense clause for NATO, just remind everybody when it has been invoked and who benefited from that.
Right. Well, I mean, so the president has said repeatedly that the U.S. gets nothing from NATO. Obviously, the time that Article 5 was invoked was after the September 11th attack, and a lot of NATO countries came to the U.S.'s aid, and you saw participation by NATO forces in Afghanistan. So that was really the big one. Of course, it would have been an extraordinary and chaotic situation if the U.S. had decided to attack Greenland, and you would have essentially had to have had NATO invoking Article 5 against one of its own members, and then you would have essentially seen the total dissolution of NATO. So at least for today, late January 2026, we are not going to see the dissolution of NATO, but who knows what the president is going to say in the next day or two.
Well, investors certainly like that, and probably like even more that we're not going to see more tariffs coming down. Nick Wadhams, thank you so much. Nick, of course, Bloomberg News National Security Team Leader out there in our DC bureau.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Netflix shares tumbled earlier in the session by as much as 6%, off their lows now, as we see some buying across risk assets late into the trading day. Netflix shares down about 2.9%. Right now, the stock taking a hit after the company issued a disappointing forecast for earnings in the months ahead as it spends more on programming and works to close its $82.7 billion deal with Warner Brothers Discovery. For more, let's bring in Alicia Reese, Senior Vice President of Equity Research. She covers media and entertainment at Wedbush Securities. More than $5 billion in assets under management. She joins us from Lake Oswego, Oregon. Alicia, welcome back to the program. We were talking yesterday before the call about the idea of content spend sending shares lower. And it's like a story that we could have told about Netflix a dozen years ago, because this is always, apart from members, and we don't get that number anymore, that's what in the past has moved the company's stock. Is that what happened this time, or is it something different?
There are a few different elements here going on. So, Netflix does give the engagement numbers now. And, after not giving subscriber numbers for most of a year, they did give their subscriber numbers. But the subscriber numbers were really where we expected them to be. There was no surprise there. I think, there was some disappointment in how much advertising revenue that Netflix was able to squeeze out of a quarter as big as Q4, when you had, all those live events, including NFL games on Christmas, some boxing matches, and of course, Stranger Things. And you had a lot of, people coming onto the service and a lot more engagement around those events. Netflix should have been able to get some pretty significant advertising revenue. They did get decent amount. Advertising revenue did grow 2.5 times year over year. And they do expect another doubling in 26 to about $3 billion. And that's satisfactory, but it's not, exciting. just yet. There's still a significant growth opportunity for Netflix in advertising. And I think the hurdle so far has been just that they haven't had the data stack and the attribution available for advertisers significant enough for them to really, do all of the campaigns that they would like to do. They have great alternatives right now across social media and other connected TV items, but Netflix is really catching up on this. And I do think that they'll be able to exploit that opportunity in the coming year or two.
So advertising being the big surge, Alicia, when it comes to boosting the top line, the revenue line?
Yeah, I think that's their biggest opportunity in the coming years. 26 is the first year where that's really meaningful. It's a meaningful contributor to its growth opportunity. And the $3 billion mark that they set for themselves, they can easily surpass that if they get all of the pieces in place. And that excessive content spend, or what might look excessive content spend relative to the engagement, will look a lot more reasonable if a lot of that engagement is on the ad tier. Now, they said that they're planning to do some price increases in the year. And I think that's going to be mainly on the premium tiers, trying to urge more of its users over to the advertising tier, which is significantly cheaper. If they get a lot of that engagement on the ad tier and a lot more advertisers in front of them, that results in profitability.
The $82.7 billion deal for Warner Brothers Discovery. Predict this for us. Does Netflix get these assets?
The regulatory process is going to be long, drawn out, and very difficult.
Why do you think that in this case?
Yeah, well, there's two different sides of it. On the one side, there's the consumer side. It's going to be hard for Netflix to argue that the likes of YouTube, billions on YouTube are real competitors. You do have some subscribers, but it's a significantly lower portion. Not all media is going to be, considered a competitor. If you only have real competitors in there, Netflix does have significant market share and will have quite a bit when they have HBO. On the other side, it's content as a content buyer. It's going to consolidate power pretty significantly for, against producers of content. And so it'll give Netflix almost too much, collective power against those producers and how much they'll spend on content. So it does diminish some power in Hollywood potentially. And, the prosecutors will be able to argue that.
Alicia, you've got an outperform. You've had an outperform for a while. I think you've moved around the target price. Right now, you're looking for about 115 a share on Netflix. So that's some room to the upside. I mean, the stock right now trading just under $85 a share. Is it, though? We just talked about, you stressed that the revenue is certainly going to be a big opportunity for this company, ad revenue growth. Is that what gets it to the target, or are there other things? Is it also the completion of the deal? And if that deal doesn't happen, then what? What does the growth story look like for Netflix going forward? Is ad revenue enough, or do they need that deal to help with that growth in the ad revenue?
So my price target does not include Warner Brothers at this time, and it won't until the deal closes. Right now, my assumption is that they're going to just continue operating as Netflix, at least for the next, year plus during the regulatory process. So my $115 price target is 1 year out, includes only Netflix and its own, internal opportunity with ad revenue growth. And so, should that deal go through, that will, significantly improve Netflix's ability to leverage its ad stack, which by then should be, absolutely booming. So I do think there's a lot of upside opportunity with or without Warner Brothers at this point.
Okay, what happens though if a competitor gets it? You said there's still a lot of upside, even if Netflix
content gets more
get
expensive.
Okay.
Yeah, that is the issue. Netflix has been making a lot of partnerships and content. They made their one with Sony recently. Of course, they have their, content deal with Warner Brothers, and they've seen how successful that content library is for Netflix on Netflix. And so owning the content makes a lot of sense. It'll save them a lot of money on those content costs. If somebody else gets the content, it could potentially be more expensive, but Netflix buys that content, plenty of content from Paramount already. So, it's just a matter of, will Netflix continue to spend this much on, procuring content through licensing deals and then producing its own content, and a combination of that, and a combination of international content as well. It certainly can. It just would be a little bit more profitable, especially if they're able to leverage that content against a global, base that utilizes advertising.
Okay, so years ago, Netflix said all we're doing, is sending DVDs to people, and that's our business. Yeah. Then they, Quickster and the whole spin-off, and that didn't end up happening. But then they're like, okay, now all we're doing is focusing on on-demand streaming. We're never going to do sports. We're never going to do anything live. They threw all that out the window. They're doing everything right now. They're doing advertising. They used to say we'd never do advertising. What is left for Netflix to do, at least from a content perspective, if they're doing games, if they're doing sports, if they're doing these live one-off events, if they're doing the live not one-off events and getting actually rights to broadcast sports, if they're doing podcasts, what's left?
Yeah, I mean, there's a lot left in terms of gaming, cloud gaming. They have a really big opportunity there as cloud gaming becomes more pervasive on connected TVs. They have a good opportunity just given their global base and the number of gamers out there. They can do a lot with that. I think they could become a really important platform for gaming, similar to, some of the consoles. They can operate as such, licensing in a lot of really quality, high quality gaming content, and then leveraging their own IP as they see fit. There are a lot of other opportunities in sports. To your point, they don't have to, they can do one-off events. They can do, WWE, which has been really successful for them. They're going to do, the baseball in Japan. I think that's a really important step for them. And it doesn't have to be global. It can be localized. They can also leverage their global base to bring sports that are not big in certain regions to those regions and create a larger fan base around the world. Take Gaelic football to the U.S., for instance, that could work. There are a lot of different opportunities within those. I think podcasts, the whole idea is to have content that will appeal to every one of their subscriber households and keep everyone engaged. And however they need to do that is what they're going to do.
Alicia Reese, Senior Vice President of Equity Research covering media and entertainment at Wedbush Securities. Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, also on the president's radar is his move to ban institutional investors from buying single-family homes. The latest proposal from the administration to address housing affordability ahead of this year's midterm elections. He actually signed an executive order on this yesterday. The president addressed housing affordability in his speech in Davos earlier today.
Every time you make it more and more and more affordable for somebody to buy a house cheaply, you're actually hurting the value of those houses. Now, if I want to really crush the housing market, I could do that so fast that people could buy houses. But you would destroy a lot of people that already have houses.
That was President Trump earlier today. Jonathan Reckford knows what it takes to build affordable housing. He's CEO of Habitat for Humanity. He joins us from the World Economic Forum in Davos, Switzerland. Jonathan, good to have you on the program. We spoke a lot last week about institutional investors owning single-family homes in the U.S., and the data are out there. It's actually a small percentage of the homes in the U.S. are owned by institutional investors. In your view, would banning these folks from owning single-family homes ease the housing crisis in the U.S.?
Well, first, we're just pleased the administration is talking about housing. And I think the housing crisis is such a huge issue in the U.S. and globally. And I'm glad it's on the agenda here at Davos as well. And we would say that now that middle-class families' children cannot afford housing, the more invisible housing crisis has become visible. We haven't taken a stance on the issue that you've just raised. We still want to look at the details. Mm-hmm. There are certain markets. Nationally, it's a very small percent. There's certain markets like Atlanta, Charlotte, a few others where it's a meaningful percentage. But that's only one small piece of the broader housing issue. And what we really have is a supply problem. We have a massive shortage, particularly at the low end of the market, starter homes. And so our view is creating a lot more supply on the starter home side would not actually damage home values in the middle and upper ends because we have such a shortage right now. In fact, if we work more on the demand side without increasing supply, we'll drive house costs up further, and it won't really solve the housing crisis. So we need really a little bit of of everything. We do need demand side solutions, but the most important thing is to increase the supply of houses at the low end of the market.
I don't always understand. I mean, I understand giving developers breaks and tax breaks to build in certain areas that maybe need some juice and some help, right? To get it kind of back and bring back a community, bring back a city, bring back a town. But I'm amazed at like tax abatements that still get given in areas where things are good without any maybe provisions to make sure that there is housing for everybody in the community, not just the wealthier folks. So how do we really fix this? I mean, I just don't understand. What's the incentive to developers or builders to really help out here? And is that what it needs to be?
I do think it requires incentives, but also requirements. And the best model for anywhere in the world is mixed income, mixed use, where families can be close to where they need to go to work and where they have economic opportunity. But we haven't planned that way. And I think there's no magic bullet, but there are a whole series of things that can help. And I agree with you. If there are incentives, that should come with expectations of mixed income, or that because the math is tough. COVID was kind of a perfect storm on affordability. So the gap between what it costs to build a unit of housing for Habitat or for a private developer and what a family can afford is the widest in history. So we do have a real math problem, and I think there are different ways to solve it. We've seen at the local and state level, first, you can make it faster and easier to build. That doesn't cost cities a lot of money, but can make a big difference for builders and developers. You can address zoning at the local level, get rid of parking minimums, increase density, get rid of minimum lot sizes. A lot of 1980s strategies that aren't relevant today that would increase supply. You can do accessory dwelling units. At the federal level, I think incentives tied to building at the starter home level and increasing the supply. So discounted financing. As the Senate has a good bill we've supported on the road to housing. The House has a strong bill as well. I think there is bipartisan support for doing something on housing. So we're enthusiastic the administration wants to support it. We know it's one of the biggest drivers right now. 1 in 3 families in the world lives in inadequate or substandard housing. 1 in 6 families in America is spending over half their income on housing right now. So the level of cost-burdened families is the highest it's ever been. And a lot of historically affordable markets have more than doubled over the last 6 years.
I think one of the challenges that you raise is the local level. And if this stuff is left in the control of voters, you oftentimes see pushback against zoning, the so-called NIMBYs, not in my backyard. We only have 30 seconds left, but how do you get local officials to push through this stuff that doesn't end up being very popular with people already?
I think you have to make the moral and the economic argument. What we're seeing is employers can't hire workers because they can't afford housing. That starts to turn the pressure. If you ask almost any mayor in America now, for the last 3 years, housing's been at the top of the list of their issues. Governors now would say housing is the top of the list. You see conservative governors trying to reduce local zoning because they can't get enough workers for their new factories or newly recruited jobs. So I think it does take getting hearts and minds and think about it. It doesn't have to be housing everywhere, but we need density, more density around transit, and we need thoughtful density. And I think we have good models for that.
Jonathan, safe travels, and please come back soon. We'd love to continue this with us. Jonathan Reckford, CEO of Habitat for Humanity. This is Bloomberg.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
TikTok?
Yeah, 18 minutes to go, just under 18 minutes. I kind of have lost track today. It's been a weird hour and a half or so, if you will, in terms of, we've obviously been focusing a lot out of Davos, the president speaking, and then we did see some comments when it comes to Greenland, and we did see equities certainly moving higher, so some enthusiasm coming back into the markets. But it's been a lot, again, in a 24-hour news cycle.
I want to bring in Gregory Peters, Co-Chief Investment Officer of PGIM Fixed Income. The firm has about $1.5 trillion in AUM, more than $1 trillion at PGIM Fixed Income. He joins us here in the Bloomberg Interactive Brokers studio. I had to kind of rip up the intro that we were going to do for you because a lot has happened just in the last half hour. I want to start with the Greenland comments because it moved treasuries. Long end took another leg higher in late trading. President Trump said he reached the framework deal on Greenland after speaking with NATO Secretary General Mark Rutte at Davos. The view of U.S. Treasuries right now, did it change for you at all this week with the pushback from some Europeans who say the U.S. is not worth investing in right now? It's not creditworthy. The president's changing dialogue about Greenland. Is it noise or is it meaningful?
I think it's both. So just because there hasn't been a sustained reaction today doesn't mean there's not medium to longer term implications. I do believe that over time you'll see less enthusiasm to invest in U.S. Treasuries. Will that happen right now? No. You see it in the tick data, you see it in other data. The flows are still pretty sizable into Treasuries. But what we're seeing and what we're hearing, particularly outside the U.S., is just less enthusiasm and this quote unquote passive allocation away from Treasuries. So you're just less likely.
Why less enthusiasm? What are the reasons given?
Well, it manifests itself through this notion of risk/term premium, right? Yeah. The back end. And if you kind of look at the U.S. versus other jurisdictions, it's still pretty flat. Japan's a classic example where there's been a massive repricing. All else equal, that takes money out of treasuries into JGBs as well. And so what we're seeing and hearing from Japanese investors is that finally, after a very, very long time, it's more advantageous for them to remain in their local market instead of going outside. So that's one factor. But these things just take time. And everyone wants this immediacy, this snap reaction. And I don't think the market works that way. It's too large of a market and it's too well entrenched, but it's over time we'll get a better sense.
So what does that mean then for the U.S. yield curve over time?
Well, I think the curve is poised to steepen. If you look at the U.S. Curve as an example, it's still not even at like the average steep levels. And it seems to me the risk out there is above average. You look at other places globally, curves are steeper. You look at the fiscal trajectory, that points to a steeper curve. You look at inflation dynamics, being just more robust than what we saw the previous 10 years. So I think all these things point to a steeper curve. And that's kind of my view and the bias there.
What gets us there, and how quickly do we get there in terms?
Well, if I knew exactly that. But these things do take time, right? So it's not going to be immediate impact. So my thought, my view, our view is that over the course of this year, you'll just see a continued steepening. So even though the markets responded a lot this week, there's a lot of informational content in the price action. So you mentioned the markets have rallied in the face of kind of the latest news, but it still hasn't completely retraced, right? So what you're seeing is these more negative moves, more pronounced than the positive, and it's not being offset one for one. I think there's value in seeing that, and I think that tells you a lot about the trend.
Is this, if it was a different administration, different policies, would we see this trade? Would we see this conversation? And I guess I'm going back to Greg thinking about how much of this has to do with the fiscal situation of the United States government. It's not, other countries have similar problems or some problems, but I keep thinking about the U.S. situation.
Yeah.
So is it something, again, specific to policies that we are seeing in this White House? Or is it, no, it's something that's been building in the U.S. government fiscal house? It's
both, right? I mean, you look at the U.S. fiscal situation. It is just continuing to worsen, all right? And so there was a step function higher during the pandemic. That's a global phenomena, as you mentioned. So fiscal is a problem everywhere, which somewhat perversely helps out the U.S. in a way.
Yeah.
But I do think, the latest fiscal stimulus coming through comes at a cost. And then I do think just how policy is being conducted has an impact on foreign investors. And you put it all together, and I think that's what matters. So it's not a single event. It's a bunch of things put together.
Well, we're sort of hearing this rhetoric come out of folks at Davos. We've got a great story that does a roundup of this on the Bloomberg terminal. One of those people, Geeta Gopinath, formerly of the IMF, said it's clear that investors no longer consider the U.S. the secure borrower that it once was. Is she right?
I think that's a little melodramatic, and I don't think that's right. But at the end of the day, the more debt to GDP you have, the worse your fiscal finances are, the closer you are to that tipping point. Mm-hmm. One of the scary aspects about this type of environment is that there is no magical number. Markets move, investors lose faith, and you can't pinpoint exactly the precise time around it. But if we learned anything, what happened in France, UK, even now in Japan, is the tie of having kind of heightened debt to GDP with, just call it, administrative political instability has a tendency of wreaking havoc on the bond market.
I do just think about, especially in the U.S. situation, we talk about the birth rate going down, an aging population, tapping into more, safety nets, if you will. We've seen this picture before, right? You think about Japan and some other nations. It just feels like a lot of nations are moving towards this, or pushback against immigration. And I'm curious, at a time where certainly more Americans are relying on the financial markets for retirement and things, like, it just feels a little messy and a little ugly here of how this all kind of ultimately plays out.
Yeah, I mean, it's always, feeling darkest or worse when you're going through it. But, there's a lot of positives going on as well. There's lots of focus on, AI as an example, and what does that mean for productivity? And if you just think about productivity through the lens of debt sustainability, if you get 50 basis points of uplift in productivity, that actually changes the whole fiscal trajectory. You go from kind of a baseline of 170% of GDP down to about 117%.
Right.
So there are some real positives here as well. But, on the immigration side, you're quite right. We've seen this story elsewhere. We saw it in Japan. We're definitely going to see it in China. We see it across Europe. And what has been a saving grace for the U.S. from an economic standpoint, this is not a political statement, but from an economic standpoint, has been actually immigration.
Oh, yeah, you just have to look at the numbers. I mean, it's not a political statement at all. We talk about this all the time. So absent that, what happens?
Well, then we're very similar to these European countries.
Got to ask you about the Fed. It seems like the president did make some comments and saying, I'm down to 3, I'm down to 2, I'm down to 1. But he hasn't mentioned one. I know, we've heard this for the last month or so. What's your comfort in feeling that whomever gets this job, it will be still an independent Fed? And we keep reminding everybody it's one vote, but it's a Fed chair vote. And their ability to maybe sway other members of the Federal Reserve. Do you have confidence it still remains an independent Fed?
I think what we saw last week was crucial. The pushback from Powell, the pushback from policymakers across the aisle, business leaders and alike, I think had this perversely positive effect on keeping the independence. But I think it's also important to remind ourselves that independence isn't a binary function, right? It's a continuum.
Yeah.
So one person chair in and of itself will not dramatically shift the Fed, but credibility is key there. And if you have a more credible Fed chair to pull individuals along, then that's helpful. And the Mirren example is a good one where he has been kind of an outlier at each meeting, and his ability to kind of coalesce and pull people with him just hasn't been there, right? And so I think that is quite telling.
The short list does that include people who are independent in your view, or could be or will be independent?
I don't know. I do have faith in the institution, but the way this whole parlor game has been conducted, I mean, it has to be called into question. But ultimately, I think it does hold. And, you're a Fed chair, you worry about your legacy, and I think just being a puppet for the administration is something that I don't think anyone wants as part of their legacy. So hope springs eternal on this one.
The one thing I would say, though, important that we do because we think about the mandate and inflation, because it does feel like we're going to see inflationary pressures persist. And that is something that we have to ensure that we've got a Fed that, wants to deal with that and keep it in check.
And that's absolutely essential. So one of the risk factors that we have for this year is this overheating scenario. Mm-hmm. There's a lot of stimulus coming through the system. As we mentioned, if you have easier financial conditions, that pushes it through. You have rates lower, that pushes it through. And the tendency will be for inflation to move higher. It's already above the 2% target. And if there's a perception by the market that the Fed is ignoring inflation, then they're basically waging war against their own credibility, and that'll manifest itself in the marketplace through steeper curves, higher term premium, and 5-year break even is a really important measure. And it hasn't moved, to be fair, because to me that's the ultimate Fed credibility measure. And if you look at that measure, it's unmoved.
Right. Without it, though, you would see a lot of nervousness and volatility, no doubt about it.
Yeah, because credibility is tied to inflation, right?
So exactly.
One begets the other, and so to ignore it is, ignoring at your own peril.
Super appreciate it. Thank you so much.
Thank you for having me.
Gregory Peters, Co-Chief Investment Officer of PGIM Fixed Income, joining us right here in studio.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.